and welcome to your Wednesday, July 24th market news update. Bank of Canada's rate decision serves as the main point of attraction today. PMI updates on the manufacturing and services front of EU to keep Euro traders occupied. Ford, AT&T, IBM and Aston Martin deliver their Q2 earning results today. Aussie's 8-day long losing streak pushes the antipodean currency towards 7-week lows. Cloud computing and advertising growth contributed to Google's 14% revenue jump in Q2. Stocks in the US closed in the reds as mega cappers' earning results generally disappointed. Finally, the yen drops climbed near 7-week highs against the USD as traders remain optimistic about BOJ's hike intentions. That's all for now, and stay tuned for tomorrow's market update.
Hi everybody and welcome to another daily presentation. This is the market overview for the 24th of July of 2024, and these are the key events that you should familiarize yourself before starting your own trading day. Now the first and sole topic of the day is going to be about Bank of Canada's interest rate decision and the prediction that market has that it will slash rates in today's session. So main attraction of the day is undoubtedly the Bank of Canada's interest rate decision for the July meeting, and market consensus points towards a 25 basis point rate reduction from the central bank. Now, Bank of Canada already slashed its rates by 25 basis points at the prior meeting, the June meeting, dragging the policy rate down to the 4.75% level, and has officially now embarked on its journey towards looser financial conditions as the Governing Council judged that disinflation is converging towards the 2% target with a favorable kind of pace. Indeed, inflation in Canada is to the 2.7% level in June, broadly in line with Bank of Canada's forecasts and the markets as well, which validated market calls and projections that see the bank unraveling further its restrictive policy practices. Now, evidently, money markets now assign an 87% probability in this scenario for the 25 basis points of rate reductions in today's session, but they go onwards and further from here, and they do assign and they do judge that 2 additional cuts of 25 basis points each, so of equal magnitude. They are indeed being priced in for the September and December meeting, which, if that is the case and we see these kind of rate reductions coming from Bank of Canada, this will leave the policy rate at 4% by year's end. So in total, we're talking about 75 basis points of cuts. That is wrong, is actually 4.25%. So if we go ahead with this, so this is the current trajectory, or at least the current outlook that the market has. We will see whether the Bank of Canada is going to or is sharing the same kind of outlook horizon going forward with its policy decisions. Also of great importance is going to be, or are going to be, the contents of the bank's accompanying statement that could provide traders, investors, economists, and any other market participant more data in order to assess much more accurately the central bank's intentions going forward. Inflation is going to be the big topic that we will be looking closely at. The projections, have they shifted? Are they going to be readjusted? Possibly lower going forward because they see enough evidence that inflationary pressures will ease much more quicker, much more swifter towards the 2% target, or the complete opposite. We will again, look closely upon this data. Also of importance is going to be the GDP projections going forward, another big issue. So if dismal or downplayed kind of GDP or growth projections are expected in the future, more likely is we're going to see the bank loosening further its stance, or at least have much more evidence or more data for them to go ahead with more rate reductions. Also, employment is going to be closely watched. Okay, so these are the three main key pillars that we will be looking at in the accompanying statement of the Bank of Canada report post their decision. Nevertheless, we must close by noting and highlighting and saying yet once again that the comments that we have heard from the central bank at the prior meeting, which they highlighted that upside risks to price growth indeed do remain. So there is a fear of inflationary pressures reigniting for some reason going further from here onwards, which is magnified by the uncertain geopolitical tensions, and we do have a lot of them. We have United States politics currently in shambles, with President Trump being, let's just say, President Trump's attempted assassination a few weeks back, Joe Biden's absence, we might call that, over the past week or so, and for some reason we don't know where he is, and we have received a comment on Twitter saying that he's currently dropping out from the 2024 presidential elections, and now the Vice President Kamala Harris is going to take on the campaign of the Democrats for the ballots at 2024 elections. So everything is at stake. We have ongoing war in Israel with Hamas, possibly Hezbollah as well. We have the Ukraine war with the Russia war with Ukraine. We have a lot of geopolitical uncertainty, which for some reason makes sense why the central bank is going to be looking closely to these kind of developments to see how this is going to affect the wider economy in general, and therefore is going to affect their stance on how they will proceed with rates going forward. But we're going to focus primarily on the economic side of things. The data that we have available in front of us do validate further cuts from the Bank of Canada. This is our call as well. So looser or a weaker loonie may be expected going forward. Again, we will wait for this data to come out and confirm our kind of biases. If not, we're going to adjust our outlook accordingly. So for the time being, we're going to leave it there. Thanks for watching, guys, and we will catch you on to tomorrow's session for hopefully another brief update. For the time being, take care. Bye-bye.
Hi everyone, and welcome to the earnings season section. And today we highlight the releases from Ford, AT&T, and IBM. Ford, the worldly-owned automaker, provides, delivers, and services a series of trucks, commercial cars, vans, and sport utility vehicles worldwide, and is the 13th largest company in the automobile manufacturers industry, according to market capitalization metrics. Analysts forecast that Ford missed both its earnings per share and revenue targets in the second quarter of 2024 by -7 cents and -$247, respectively. Point of interest will be the company's EV strategy outlook plus any potential cooperative plans with other manufacturers. Strong profits are expected to arise from Ford's core markets. AT&T is a worldwide telecommunications and technology service provider and is the third largest player in the integrated telecommunications services industry, according to market capitalization metrics. Analysts forecast that AT&T missed its earnings per share target by -9 cents in the second quarter of 2024, but beat its revenue target by $225 million, respectively. Point of interest will be the company's free cash flow and subscribers growth in Q2. AT&T free cash flow metric to judge its fate onwards. Moving on to IBM. IBM is a multinational technology provider who primarily sells software, IT services, networking and cloud equipment alongside hardware such as computers, servers, and storage systems worldwide, and it's the second largest company according to market capitalization of the IT consulting and other services industry. Analysts forecast that IBM beat of both its earnings per share and revenue metrics in the second quarter of 2024 by 12 cents and $96 million, respectively. Point of interest will be the company's software services growth and the progress of its generative AI consulting projects. IBM software and Gen AI growth, the main points of attraction. That's all for now, and thank you for watching.
Welcome. Hi, everybody. Okay, I see people joining in. Sorry for the slight delay. I had to upgrade my password in Zoom. Let me fix up a few things and we will be on our way. Guys, can you please let me know in the chat whether you can hopefully communicate with me? Please type something in the chat to see that the messages are coming through. Let's get this test up and running first. Please let me know also whether you can hear me loud and clear. That would be nice. Okay, people joining, that's good. Welcome. Hi, Joe. Thank you for the confirmation. You can also actually hear me loud and clear. And you can also see the first slide of the presentation. Give me a thumbs up, please. Okay, I see Jackson, Ryan. I see the banners. Joe as well. Michael, I'm sorry. Yes, thank you for the confirmation, Joe. Yep. So a brief intro, and we're gonna be right on our way. Hope you are all having a lovely Friday. Super hot. Hopefully you're near the sea or something, or a pool that you can go and just jump in and cool down. Right where I'm here is kind of super hot, so yeah. Thankfully, we have air conditioning. So yeah, still people joining. Welcome, guys. Welcome. So in this webinar, we're gonna go down the path of technical analysis once again. Okay, more specifically today, we're gonna speak about the lovely indicator named ADX, or in other words, the average directional index pioneered by Mr. Wells. So it's going to be super fun, super easy to comprehend because let's be honest, who wants to complicate matters? This is a fairly simple to understand and comprehend kind of indicator, super insightful, at least from my point of view. I use it on a daily basis when I do technical analysis. Hopefully you will by the end of this session as well. So again, I'm going to try to keep it as simple as I can. But yeah, so without further ado, let's get started. If many people join, we're going to do a small recap for them for the time being. Let's kickstart the whole thing. So this is a quick risk warning and a disclaimer. We can read this at your own time. No need to go through the whole thing. The point is, this is for purely educational purposes only. This is not containing any sort of advice or investment recommendation. Again, this is for purely educational purposes. Now, so types of technical analysis. Remember in the past, I've kickstarted this whole series in order to, let's just say, pass on a few relevant information that people can use, hopefully, when they begin their journey in technical analysis. This is a split off of one of the two main categories, at least from my point of view, when it comes to technical analysis. This is the second branch. The first branch was charting analysis. In a sense, you go on top of the price action and you draw lines, which are, for example, or you can do channels and you can do trend lines. You can place support and resistance levels manually with your eye, looking at former highs, former lows, and setting those areas and highlighting those areas with the available tool that you have with your platform in order to, keep an eye on the price action and see where it might stall or there may be a possible breakout or a breakdown from where you see price action reversing from and all that kind of stuff. These are the tools. These were the tools that I mentioned earlier on that are pretty simple and basic, and you can deploy them at your own will when you do charting analysis. And again, I'm going to recap. You do trend lines, you do support and resistance levels, you do channels and all that kind of lovely, simple stuff in order to get a guidance of where the market is moving and how you want to approach your trading journey with that, whether you're going to go with the market, which is the obvious thing to do, or whether you're going to be a contrarian and wait for a reversal and capitalize upon that. That's up to you. So that was the first aspect or the first branch of technical analysis. Again, from my point of view, this is not written in stone. This is my way of interpreting these kind of things. The other branch is mechanical analysis, and here you can see in this slide few of the many, and there's multiple and many numerous kind of technical indicators that chartists use in order to make their life much more simple and their trading journey much more efficient. So this is a split off of mechanical analysis, which employs, in other words, quantifiable kind of metrics that spit out variables, which are, in other words, the indicators that we use. Those are computerized kind of algorithms. That's one way of conceptualizing that. When you apply them to your chart, they give you different information, whether that's going to be about momentum, whether it's going to be about a possible reversal point if you're using, for example, Fibonacci, whether the price action is merging with the long-term or short-term moving averages to see what is the actual state of the trend. There's many indicators. Here are a few, and there is a split off between those indicators of mechanical analysis that fall under the broad category of mechanical analysis. We have on-chart indicators and off-chart indicators. In the past, we have covered moving averages, Bollinger Bands. Hopefully, we're going to do Ichimoku soon. I'm not there yet. I'm going to come up with a webinar, hopefully, to discuss these issues
no issues, but these components kind of in a very simplistic way. And once you digest that simplistic point of view, you can use them at your own will. Afterwards, again, it's challenging topic, the Ichimoku clouds. There's a lot of things that go into it still. We also covered in the past Fibonacci's, more specifically retracement and expansions, which are on-chart indicators. Off-chart indicators, we have covered RSI, the Relative Strength Index, one of the most widely used indicators, captures momentum and the pace of acceleration or deceleration of a current trend or the price action. We have used the past moving average, convergence, and divergence, one of my favorite ones. Today, we're going to cover ADX. Hopefully, we're going to do ADX as well with it to see how they can be used in synergetic kind of way. They complement each other. They are pretty similar. They're not explaining the same thing. For example, ADX uses average true range, whereas moving average, convergence, and divergence uses close prices. There's a few details and that when you place them together, however, they enhance the way you study the trend of a specific instrument or the market in general. Okay, so the other one is momentum. Super simple. ADX today has some elements of momentum as well. It's a branch off, or it's a derivative, if you would like, of momentum. RSI as well. So I don't think there's a need to go into much more detail about momentum. Today, we're going to focus on ADX. Okay, I see still people joining. Welcome, guys. Hopefully you have a lovely Friday. We haven't started yet. We're just doing a small overview. Okay, hold on to your seats. We begin right now. Okay. Hi, Torsten. Hi, Tanmei. Sorry if I'm butchering your name. Apologies. Suyo, Ryan as well. All right, maybe it was beforehand still. Let's move on with the Holy Grail. So, ADX, Average Directional Index. Again, I'm going to try and keep it as simple as possible. Let's begin with a small history. Okay, so history lesson. The Average Directional Index was designed by the legendary, and the guy is a legend, technical analyst, Mr. Wells Wilder, the senior, not the senior, the junior. Initially for commodity charts, that was back then in the 1980s, but since then it has been modified as a technical indicator, and it can be used on other markets and other instruments and across many time frames. So it's a pretty useful tool, okay, that goes beyond the commodities kind of market. Okay, you can apply the ADX as an indicator or any given chart once you understand the rationale behind it. Okay, and this is what we're going to attempt to do here. Okay, these modifications allow the ADX to become what it is today, an indicator to track the strength of a market trend. Okay, if there's something you're going to take away from today's webinar, is this: ADX measures the strength of market trends. That's it. Okay, now we're going to do the small, now we're going to go over into the details. Okay, it also analyzes set trends with the aid of additional directional indicators, which are the other quote-unquote components that have been added to the ADX, which is the positive directional index, the positive DI, and then the negative directional index, the negative DI. Fear not, we're going to see them soon. Okay, so Wilder introduced the ADX in his book back in the 1980s, 78, which was called New Concepts in Technical Trading Systems. I've read this book twice so far. It's super enlightening. We're talking about a guy that revolutionized mechanical analysis when it comes to technical analysis in general, or chartists, for chartists as a not an industry, but as a profession. Okay, so he came up with, for example, what we use widely today, the ATR, the average true range, the relative strength index, the RSI. Okay, comes from the same guy, parabolic SAR, but also many other different indicators, which again, these are considered to be the basic or the default kind of tools for people that start trading from the get-go. Okay, because they're super easy to understand, okay, comprehend, and then put into action. I mean, the action part is obviously up to the trader. You need to adjust accordingly depending on your needs and wants. But yeah, the indicators are there. They're free to use. They're easy to apply to your chart. You're not going to do any manual calculations. They're already computerized and easy to use. Okay, so why not use them when you have the availability of them and the convenience of it, having it for free and doesn't work for you. Okay. The point is, yes, you add it to your chart, then understand how they work, what kind of signals they give you, whether they are reliable or not. It's going to be up to your interpretation. Okay. But there are many high frequency trading kind of algorithms that mechanically use these kind of indicators. So if you want to come up with an algorithm yourself, or expert advisor kind of thing, where you program the machine, in a sense, to place trades for you, these are one of the most common indicators are used for inputs in order for you to enter and exit a trade dependingly. Okay, so it's super useful. Please go through them. They're life-changing if, for example, you are starting your journey right now. Okay, understand them and then add them or not to your chart if you like. But yeah, they're super helpful. So definition of ADX. Give me a moment, please. ADX, the average directional index, is a specific indicator used by technical analysts and traders as well in order to determine the strength of a trend. Okay, the trend, as we mentioned many times in the past, can be going either up or down, but also we also have this mode which we call consolidation or a sideways price action, where the market is not going pretty much anywhere. It's confined between two bounds, visible bounds, and it has no direction. It's not going either up or down. You can use other indicators, for example, CCI for that, and trade accordingly with that. But now we're going to be focusing primarily on the two most important directions of the market, up or down, upwards or downwards, or in other words, bullish or bearish kind of conditions. Okay, so this is why we use the ADX, because it's a primarily a trend following kind of indicator. So you use the ADX when you have a trend. If you don't have a trend, no need to use the ADX. Obviously, the ADX is gonna tell you that there is no trend. Again, there might be some usefulness in that. But when we come to the fact that we want to actually take when we want to take action upon the markets and we want to place trades, we do care about the trend primarily and not the trendless kind of conditions. So that's why we use the ADX. So the trend can be either going up or down, which is shown by two indicators which often accompany the ADX. As we mentioned, the positive directional indicator, known as the positive DI, and the negative directional indicator, which is known as the negative DI, which are derived from directional movement indicators. We're going to see them soon. Okay, so it is for this reason that the average directional index is presented with three separate lines, symbolizing each indicator. Again, you're going to see a visual illustration soon. So each line is used to help assess a trade and whether or not it should be taken as a buy order, a long order, or a short order, or if you're going to take an order at all. Okay, at some points in time, you have no clear indication, no clear direction. What's the point of hustling? Move on to the next chart that has an actual trend and do your trading on that kind of instrument. Again, it can be used as a filtering mechanism as well, this indicator, this ADX. Okay, and we're gonna see what kind of information it conveys on whether we are actually experiencing a trendless market, and if yes, you move on, or you await for a trend to begin or re-emerge. Okay, you're gonna see the situation analysis later on. So positive directional indicator. So the first companion of the ADX, the positive DI, is the positive directional indicator, which is in essence measures the strength of the bulls. Okay, that's it. The green line, the positive DI, measures the strength of the bulls. Okay, it is represented by a green line. And in other words, it tells you how many and how strong is the momentum or the leniency or the needs of bulls and how they are viewing the market currently. Is this instrument long or asymmetrically long positioned? That means there is too many bulls compared to bears. If that is the case, most likely you're going to see the price action heading north. If the current price action, if the current state of being in that specific instrument is primarily represented by a higher value of the negative DI, means there is more sellers than buyers in the market, most likely you're going to see a fall of price action. Okay, and these indicators, these positive and negative DI, represent the strength of both the positive represents the strength of the bulls and the negative represents the strength of the bears. This is crucial to understand and digest as soon as possible, because this is pretty much the component of ADX. The ADX we're going to see soon is, in a sense, the difference between the two. Okay, so the larger the asymmetry between the bulls and the bears, for example, you might have over optimism, so there is a lot of bulls in the market, there's a lot of strength, buying strength, and there is absence of sellers. You're going to get a divergence between the two lines. So the green line is obviously going to be, has a higher value than the red line, and the higher or the bigger the difference between the two is represented by the ADX. So the ADX, once again, measures the strength of a trend. Okay, so irrespective of whether the green line is above the red line or not, the ADX gives you the strength of the current trend. Neither upside nor downside. Okay, actual trend in place. The ADX, a spike in an ADX, okay, value means there is a strength, an underlying strength in the current trend, whether that is upside or downside. The who is in control is set or is shown by the positive and the negative DIs. You're going to see it again visually soon. So therefore, when you have a positive DI or a directional index has a higher value than the negative DI, it is interpreted that the bulls are in control of the move. I don't know if you can see my mouse pointer here. Let me get the laser pointer. Okay, I'm somewhere in here. Okay, so when you have strong values of positive DI higher than the negative DI, bulls are in control. Okay, so the larger the value of the positive DI, the wider the gap it will be shown in the ADX indicator, and the negative DI with the higher chances that the bulls are in control and they are still willing to push prices higher, assuming that the ADX is also picking up as well. Okay, you see. Again, remember, the ADX does not care which line is on top. Okay, whether you're going to see the positive DI above or the negative DI above, it doesn't care. The ADX is going to pick up anyway if there is a large deviation between the two values, if there is an asymmetric representation of either the bulls or the bears. Okay, so the ADX is the indicator that measures the strength of the trend. That's it. Please do not confuse this. It's super simple. It's merely representing the strength of the move, either to the upside or the downside. Whether it's going to be up, it depends upon the other two lines, the green and the red, the positive DI and the negative DI. Okay? So, thus, as a rule of thumb, buyers seek out the larger or the positive DI value compared to the negative DI value, sometimes multiple highs above that. For example, a positive DI is going to have a value of 30 and negative DI has a value of 10. So this 3 times higher the buying pressure compared to the selling pressure. Most likely you're going to see the price action appreciating from here onwards. Okay, and a rising ADX is also the key component that you need to seek out for to see whether that actual trend is going to pick up from there onwards. Okay, whereas short sellers will indeed look for higher negative DI values compared to a positive DI values alongside a rising ADX. Somebody raised their hand. Do you have any question? I didn't see which of you guys was. Shall I continue? Okay, send your question through and we get it addressed. Okay, so interpreting Tanmay. Okay, what is the question? Can you type in the chat? I think you can. Please let me know in the chat. So yeah, interpreting the ADX. Okay, this is a lovely cheat sheet, if you would like, to comprehend what we're talking about here. So you have one column, the ADX value, and the other one is the indication. Okay, what we care about at the end of the day. So a rising ADX value signifies a strengthening trend. Give me another. Yeah, I'm going to address the question right now. Is this a lagging indicator? Of course, yes, because it uses past data. Nothing, pretty much, I haven't come across a reliable leading indicator for the time being. My leading indicator is on the fundamental front. I look at those kind of indicators, which are not computerized, but still, when it comes to technical analysis, leading indicators, I don't know. The ADX is pretty good at picking up subtle and not subtle, but obvious strengthening of either the bulls or the bears are visually represented there. They're going to be lagging, but not that much. Okay, so you will definitely have time to react if that is where your question is leading to. Okay, but at the end of the day, yes, it's a lagging indicator. Okay, hopefully I've addressed your question, Tanmay. So moving on to the cheat sheet. Okay, so we have a rising ADX value. Okay, means there is strengthening trend, or the trend is picking up, whether it's to the upside or the downside. When you have a falling ADX value, obviously it's the complete opposite, which means there is a weakening kind of trend, or there's deceleration of the current trend. Okay, so another thing I failed to mention is that on the ADX indicator, when you put it on your charts, you're going to have the ADX, most likely, irrespective of the colors of the lines, you're going to have the ADX, you're going to have the positive DI, the negative DI, and you also have the threshold. Okay, threshold is set and is most of the times fixed at the 20 kind of area. Okay, signifies as is the threshold of whether the trend is strong enough or not. So an ADX value below 20. Now, why the 20? I'm not quite sure, to be honest. But it can be adjusted to 20, 25, 23, whatever that is. But it acts upon, it is acting as a threshold. So when you see the ADX value coming below the 20 mark, it signifies that the trend is going to be most likely stalling. There is not enough strength. Okay, whereas if you have a value rising above the 20 and staying above the 20 and going 40, 50, 60, that means there is a pickup on the strength. Okay, so that, keep that on the back of your minds as well. So 20 means a weak, below 20 means a weak trend, above 20 means strength in trend. So you also have another split here. So between the 20 and 40, we have what we call a strong trend, whereas above 40, you have even more extreme trend. Okay, some people like to go long between the 20 and the 40. If the ADX is in there, that signifies enough strength, enough momentum, whether that is to the upside or to the downside. And they start to close the positions when you see the ADX value going well above the 40, excuse me, extrapolating that, you know what, at some point in time, the bears are going to enter the picture, or the bulls are going to enter the picture, depending on where the market is going. And you're going to see a reversal, or at least the slow deterioration of the trend. Okay, so they use the ADX also to optimize their exit. For example, the entry will be between 20 and 40, and the exit may be some range above the 50 or above the 40. Okay, but I know traders that go only into trades when you see an ADX close and above the 40, and the only difference is that the time frame, okay, it's much smaller than the other ones. Okay, so you go long, for example, in a position in an instrument where you have a positive DI value, let's just say 30, 40, 50, an ADX which is also around the 40 level, and a negative DI which is somewhere around the 10. Okay, so they go long when they see the ADX breaking above 40, and they have a short-term kind of horizon, and they exit the position using, for example, either the ADX or the RSI, which is a little bit more quick to show signals. Okay, when you see the slope of the RSI picking downwards, they say, I've seen enough. I'm going to take my 3, 4, 5, 6%, whatever that is, or 10%, and get out of the picture. They are, in a sense, capitalizing upon the momentum of everything. Okay, the strength. They take positions on the peak, which is, if you have not done this, if you have not practiced in the past, it's kind of a weird place to enter a position and get yourself on the opposite side of the trend, and you see quick retracement from there onwards and you stay with losses. It's much more riskier. It's not suggested. Most people go for an entry point between an ADX of 20 and 40 and the exit when you see deterioration of the strength. Okay, I've seen people go into position when you see the ADX just breaking above the 20 super early, and they say, I want to sit in this trade for as long as possible. I'm expecting the ADX to take place, and I'm expecting the ADX to strengthen up and push the prices to, let's just say, to the upside. I'm going to be an early bird, and I'm going to capitalize upon the entire rally. Okay, it is up to you. Okay, the point is, understand what the values are signifying with this lovely cheat sheet here. Okay, so what is the next slide? Okay, this is a complete breakdown of the components of the ADX. I don't think we're going to need to spend a lot of time in this. This is super nitty-gritty details. These are not going to be done manually by you. These are the settings that are computing, okay, how the ADX is computed by the system. Okay, only need to know a few steps out of the whole thing. Let's just go ahead with, for example, how the DI and the positive DI and the negative DI are computed. The point here is just to understand what are they telling you rather than just fixate upon how they are calculated. Even though it's beneficial, it's not that much. It doesn't add that much to your knowledge. Okay, so start by off calculating the positive directional movement, not DI, directional movement, DM, and negative DI, and use the true range. Remember at the first slide of the presentation, I mentioned that the ADX is using true range, okay, compared to the MACD that uses close prices. In a sense, what is true range? True range is the highest that the price action has gone over the past, let's just say, X amount of periods, okay? The highest high, we're talking about the peak of the week, the top that it has, even though it has closed lower than that, and the lowest of the low, okay? It calculates the difference between the two values, so the lowest of the day and the highest of the day, and you average that out as you go backwards because it's a lagging indicator. You compile information from the past, so you use the highest of the prior day and the lowest of the prior day, okay? And you sum up all the X amount of prior days, and you get the number of the ADX, whereas the MACD, it summarizes the prior close prices, okay? Not the open, not the highest, not the lowest, but the close prices, the closure low, okay? This is the main difference between the two. So the ATR by default is going to give you much larger values than when you use the close price. Hopefully I'm not confusing you, but this is why I mentioned not that helpful to go through the nitty-gritty details. Again, we're going to go through the basics. So start off by calculating the positive DM and the negative DM. So the true range for each period you're analyzing, wherever that is, whether that is going to be 14 periods, going to be 10, it's going to be 50, up to you. The indicator, if I'm not mistaken, uses 14 periods, much like the RSI. For the past 14 periods, you calculate the positive directional movement and the negative directional movement, which is in a sense what? So positive DM is the current high minus the previous high. How far is the price action went in today's session versus the prior one, okay? Minus the prior one, the price session's high. The negative one is the previous low minus the current low, okay? So you see, you get, in a sense, what we call range. How far has the price action went between the day, okay? So you can use the positive DM, the directional movement, when the current high minus the previous high is larger than the previous low, the current low, okay? So in a sense, you use the positive DM when this equation is larger than this. This is pretty much what the calculation is, okay? So you use the negative DM when the previous low minus the current low, this one, okay, is larger than the current high versus the previous high, this one, okay? So it's a comparison between the positive DM and the negative DM, okay? The previous highs and the previous lows, okay? So the true range is the greater of A, the current high minus the current low, B, the current high minus the previous close, or C, the current low minus the previous close, okay? The reason when we say previous close is most likely if the price action has not went below the open of the day. That means there is no wick, therefore there is no new low. That means the open price is the lowest value of the day. Okay, so that's why that's how you calculate it. Okay, so you go ahead afterwards and you smooth your period averages. Again, remember we're talking about 14 periods, and you get averages for the positive DM and the negative DM, and also the TR, the true range, and that's where you get the average true range. Where is it, the ATR? That's how you get the ATR. Okay, so then you insert the negative DM and the positive DM values to calculate the smooth average of those. Again, we're not going to go into further detail upon this. Understand it uses true range. That's it. Highest of today's high minus the highest of yesterday's high for the positive DM. The lowest of yesterday's day minus the lowest of today's day. Okay. Again, this is computerized by the system. No need to do this kind of calculation. Okay. So that's why we're not going to spend any more time on this. How much time do we have, by the way? Okay. Halfway there. Okay. So takeaways and what to look for. Now, the average directional movement as well as the negative DI and positive DI indicators are momentum indicators. Remember I said in the third slide, when we had the breakdown of mechanical analysis, these are momentum indicators. These are lagging indicators. Best you can have, of the bunch. And they are used to help investors determine the strength of a trend and the trend direction. If there is any key takeaways that you can get from this, is that ADX measures the strength of the current trend. Positive DI tells you the strength of the bulls. Negative DI tells you the strength of the bears. Those are the stuff you need to remember. Okay, that's pretty much it. Excuse me. Again, the average directional index projects market price and is clearly seen when prices move up. You're going to see positive DI coming above the negative DI. And when the prices move down, you're going to see the negative DI below the positive DI. And when there are crosses, okay, this is one important aspect of the thing. When you have crosses between the positive and the negative DI, it can and it does signify potential trading signals. In other words, whether a bearish or a bullish market emerges. So conceptualize this in this manner. So you have for a X amount period of time, for example, a week, you have a positive DI value above the negative DI value. That means that the bulls are in control. Okay. Most likely, if you look at the price action, you're going to see it moving higher and higher, no matter what the percentage changes. Okay. If you have at this same period, okay, where the positive DI is above the negative DI and you have a rising ADX, you're going to see momentum spiking and you're going to see price action moving higher at a faster pace. Okay. That's pretty simple to understand. Okay. What happens at the periods where you see the positive DI now crossing below, okay, the negative DI and the negative DI rising to the upside? That, in a sense, signifies to you that the bulls are no longer in control and there is a shift in trend. This is what we care about. Okay. These are the periods or the segments where we pay close attention to when you have crossovers between the two lines, because they signify change in a possible change in trend. Okay. Now, whether the ADX is going to pick up and follow from there onwards, this is what we care about. But firstly, we raise our flags and we signify that point in time where we saw the crossover between the positive DI and the negative DI to, again, because it told us that the shift has taken place. The bulls are the bears are no longer in control. The opposite party took over. Now what we are waiting for as traders is for the ADX to pick up in order for the price action to rally or fall, depending who is on control, and capitalize upon the shift of the trend. This is, in a sense, what we're trying to do with the ADX. Okay, so a trend shows the most strength when the average directional index is above 25, somewhere there, which is interpreted in the mainstream as a potential signal to buy, and a trend is weak or the price is considered trendless when you have the ADX that reaches the 20 and goes below it. This is the cheat sheet we discussed in the previous slide, which again, this is according to the observation of its creator. So if we're going to take into account what information does it give us, obviously we're going to take it right from the source, the guy that created it. Okay, Mr. Wilder. So keep in mind that if ADX is below 20, it might not be the most ideal time to enter the trade. Most of the times is a clear signal to just stay out of this position and go find something else. Okay, or you're gonna flag this and set for example, alarms when you see a pickup in price action. It's going to notify you, you know what, the ADX is picking up. Now I'm going to pay attention to, but most of the times, if the ADX is below 20, no need to do anything, okay? It signifies that it's a trendless market. It signifies that it's consolidation. It signifies that it's a sideways price action taking place currently. No need to get there and just scalp the whole thing. Just I'll wait for the trend to emerge and play afterwards, because you need to have in place, hopefully you do have in place, is a correct and a aiding kind of money management perspective as well. Okay, assuming that you have an X amount of money in your account, you're not going to be placing, for example, 50% of it on an instrument that has an ADX value below 20, and I'll wait for the price action to for the ADX to pick up in order to capitalize upon that. You do have the option to not go into the position, okay? Find something else that is actually trending and capitalize upon that. And when that instrument you have found is actually picking up and the ADX is picking up, or the bulls are, for example, in control and they're driving the price action higher, capitalize upon that market where you have enough momentum, not instead sitting ducks on your trade and just awaiting when it's going to break out or move to that direction. Okay, it's much more logical to do this. Okay, again, it's up to you, up to your trading strategies. So another thing to remember is that if the market presents itself as not following a specific trend, this does not mean that the price isn't moving. And there is lots of occasions where the ADX is flat, but the price action is heading to higher ground. Divergence is something you need to pay attention to as well. Okay, it's not that common, but it arises from time to time. You can pay attention to that as well. Rather that it could be making change in the direction it is not currently present. So if you spot indeed a direction where you see the price action heading north, okay, moving upwards, the ADX is not picking up, but the price action is moving upwards, maybe that it's an early indication that, you know what, the ADX is going to pick up, because you see the sequential, okay, rally of the price action is going to manifest in the ADX, because remember, as Han Mei mentioned earlier on, this is indeed a lagging indicator, okay? So it needs some time to compute the prior move and then show you that indeed the movement has picked up. So if you spot indeed a direction, maybe it's worthwhile paying close attention to this and capitalize upon the ADX rallying from there onwards. Okay, these are a little bit more quote unquote sophisticated. Spotting divergences is something you need to train your eye to see, but they are super helpful indeed to spot if you practice enough. Okay, and we have done this in the past with the RSI. We have spotted RSI divergences, and the price action was indeed saying something else. And for example, it was at the rallying market, if I'm not mistaken. We saw that with either Google or Apple 3 or 4 weeks ago, where the market has been super optimistic. The market has been making headway. Yeah, it was making fresh highs, but at a slower pace. And the RSI was constantly failing, making new highs, which was your indication that, you know what, from now onwards, momentum has thinned out and the bears are going to enter the picture. And soon afterwards, you saw a sharp drop from that. Okay, so divergences are super important. Again, you need to pay close attention to the price action to understand and spot them much more efficiently. There's no cheat sheet for divergences. It's just training. It's just grinding. Okay, so you may indeed go down that path. Okay, so in summary, please let me see. Okay, those are visual illustrations afterwards. Let's do the summary and we're pretty much done. Okay, so the ADX does not indicate whether the trend is bullish or bearish. Please digest this. Okay, the ADX is a non-directional. Okay, it does not tell you who is in control, the bulls or the bears. The ADX merely tells you about the strength of the current trend. Positive DI and negative DI tell you about the strength of the bulls or the bears. Okay, ADX merely signifies the strength of the trend, no matter what it is, either up or down. Rising ADX value means strengthening of the current trend. Below 20 or weakening ADX means there is a period of consolidation. Key takeaway is this. Now, the larger value of the ADX, the stronger the trend is. Remember, between above 20 and 40, between 20 and 40, excuse me, strengthening trend. Above 40, 50, 60 regions, we're talking about extreme trends. Those are nice for you to scalp. Okay, so generally you have an ADX value of 20 and below signifies weakness or loss of the strength of the current trend, and whereas a value of 40 and above, as we said, signifies an extreme trend. Now, the positive DI and positive directional index tells you what the buyers are doing and how strong they are, and the momentum of them. Negative DI tells you what the sellers are doing. Okay, ADX tells you whether there is a trend, but also its strength. Okay, accompanied with the other two, obviously. Now, remember, ADX has take into account true range. Okay, highest and the lows of the days, i.e., how prices have rallied and how low they have reached, and it does not incorporate open and close prices. Some occasions, rarely though. Combining ADX with MACD. Okay, one of my favorite ways of looking at things when it comes to technicals, which uses close prices, so complementary behavior or relationship between the two. So supplementary is a synergistic way of judging and assessing market trends. Maybe a very enlightening and useful synergy of indicators. Again, this is my bias, that could provide traders with more accurate entry and exit signal. Okay, these are the key takeaways. Let's go on the visual illustration. Okay, I found 2, 3 examples. Okay, super easy to spot. Those are the ones you need to use as templates, okay, when you look at price action of any given instrument, okay, or at least identifying the signals beforehand, are waiting for this to manifest, okay, may or may not. What we do is go on it up, or let's just say safeguard or pick up as many points or percentage points of probability in our favor in order to place a trade. Remember this, we are dealing with probabilities here. If we have indicators coalescing and converging and telling us the same thing, that, you know what, there has been a shift in trend and the bulls are in control and they're making, the price action is making higher highs and higher lows, and you see a clear direction of the trend upwards, you go long on these kind of instruments, okay? But you need to see this convergence, okay? You need to see clear signs that there is indeed a shift in trend, that there is, for example, that their bulls are indeed in control and they're pushing price action to high ground. Now let's attempt to spot them on a chart, okay? Now remember, previous few slides we said we do care about the crossovers, okay? The crossovers between the positive DI and the negative DI are important, okay? In this kind of case, I'll mark this kind of area right here, this 15th of February. What instrument is this? We're looking at copper, okay? Copper futures. At that point in time, we saw a crossover, okay? Early signal, yes, pay attention to this. This is what, how we conceptualize this when it arises. When you see the green line coming from below the 20, the positive DI coming from below the 20 level, the dotted line here, okay? Crossing above the 20 level with a lovely slope, and the negative DI, the red line, crossing below the 20 at a sharp kind of slope as well. That means there has been a shift in those that hold the initiative. Okay, so we passed the initiative. The initiative was passed from the bears towards the bulls, or the bulls have taken it. That's another way of saying it. Okay, and now the bulls are in control after this period of somewhat stalling price action. Okay, this is maybe interpreted as a sideways kind of fashion. Okay, you see prices bouncing between this level and hitting a ceiling above here. Okay, so we move from a consolidation phase into a shift in the actual trend. Okay, and it occurred at this point in time, 15th of February, irrespective of whether it was. The point is, you see again divergence between the two. The gap between the two widens. The bulls are in control. Positive, strong values of positive DI. Negative DI plummets below the 20, signifying weakness of the sellers or absence of the sellers, where positive DI tells you bulls are piling in long positions and there is a lot of strength. So this is early sign. Okay, I'm paying attention now. I see a divergence. I see a crossover between the two. When do I place my long order in this? Is, from my point of view, is when you see the pickup of the ADX, okay? Somewhere in this area. So the confirmation came when the ADX traversed from a low reading of, I don't know what this is, maybe 13, 15, whatever that is, crossing above the 20 and sloping upwards. The slope is also important. How steep? Okay, it is. Okay, there's many times that is fake outs, but we're not going to go into that. But the slope of the ADX gave me the indication, you know what, the strength, the trend is strengthening, the bulls are in control, and their momentum or the strength of the trend is in my favor if I want to go long. So after this happens, I'm going long, and I'm awaiting when, for example, that's one way to exit the position, when the negative DI once again crosses up the 20. Okay, that means the strength of the bulls is into the picture. Excuse me, the strength of the bears. The bears are indeed entering the picture. Okay, in other words, and when the buying strength, the DI, also plummets. Okay, moves lower, crosses below the 20. In a sense, you want to see the opposite scenario taking place if you want to have that as an exit. Or you can use, for example, RSI or MACD or just your eyes to close the position once you see, once you feel that this move has been over exaggerated. Okay, and we're talking about copper here. You went from 3.8 $3.80 up to $5 approximately. So substantial gains there because the sellers were absent and the bulls have reigned uninterrupted. Plus the strength of the ADX. We have an extreme value of ADX here of what, 60 and 70, signifies supreme strength, supreme optimism, which in most cases does not last long. And this is one of your signals that you may need to just take your stuff and leave, because most likely afterwards you're going to see a sharp correction. Okay, remember the lesson we have done in the past. Price action tends to move in patterns and trends, etc., and all that kind of stuff, but there is unwritten rule, the one that we call, there is, I'm going to say absolutely most of the time, or all the time, the concept of the reversion towards the mean. Okay, that means price action, if it's exceeding and is moving way above the prior session's levels, sometime is gonna have to correct itself because there is over exuberance. When there is over exuberance, most of the times a correction follows. It is not a law, it's something that has been observed throughout the years in financial markets. Okay, when you see something going up for too long, some point in time the bubble is going to burst and price action is going to correct to where it should have been in the first place. Okay, without the excess momentum and super optimism. Okay, so what we've discussed here is when to pay first initial attention, and then when you get the confirmation to enter a position long. Okay, crossover is where we pay attention. You know what? I'm going to be looking closely at copper to see whether the bulls are going to remain in control. Once you see the ADX picking up, signifying and stamping, in a sense, your assessment that bulls are in control, the strength of the trend is underway. I'm going long and I'm capitalizing upon this rally, this lovely rally. Okay. Second example is a complete opposite. In this kind of scenario, we saw the bulls being in control. Please let me know whether you can see the pointer. I think you can. Okay. You see bulls being in control, the ADX picking up yet something at the 440 level, then flatlining and then coming back down, coincides with what the price action has been doing. But after this, and listen and look closely when it did happen, after an earnings call, for some reason, this earnings call of Snowflake has been positive. They have been beaten both their EPS and revenue targets, but for some reason, market reacted negatively to this. I'm going to assume that most likely it had to do with a negative outlook. So not what has happened in the prior 3 months, which is what the earnings report is containing, in a sense. Okay. Most likely the company has released that, you know what, over the next 3 to 6 months, we don't see enough growth in our company. We don't have higher targets going forward. That is not good news for investors. They see, you know what, enough about Snowflake. I'm going to exit a position now, because from here onwards, I'm not expecting to get higher prices stemming from positive earnings. That's why maybe you have seen this negative reaction, or it might have been a technical reaction. Who knows? In this kind of case, we saw a sharp pickup of the negative DI. That means a lot of sellers in the picture and no sellers whatsoever, no buyers whatsoever. Crossover between the two, and you see the plummeting of the price action. You see the gap down. No way you could have captured that at that point in time. Some people do, probably in the pre-market, but in these kind of cases, price action in the aftermarket, excuse me, no pre-market, the price action falls like a stone. Okay, no way you could have got that if you're trading on a daily basis. Okay, on a daily time frame, I mean. Okay, maybe the best you could have had is go short somewhere in here, capitalize upon the fall, because you have the early indication that the bears entered the picture, the buyers exited the picture, they are nowhere to be found. The ADX is once again picking up, and remember, the ADX was elevated at this point in time, this former peak, okay, and it has remained somewhat elevated. What is this level? Let's just say 30. Again, remember, between 20 and 40, that means a strengthening trend. In this kind of case, it's a radical shifting trend. Prices are plummeting. The ADX is picking up once again. The negative DI is above the positive DI. Positive DI is below the 20. Again, signals supreme selling strength. The last thing you want to do in this kind of condition is go long and say, you know what, I'm going to buy the dip. No, that was the stupidest thing you could have done. Okay. Understand what the technical indications are telling you. No way to go long in this after you see this drop. Okay. See the ADX. The ADX is telling you bears are in control. They are not done yet. They are going to keep pushing the prices to lower ground. Okay. And they have done so. And afterwards, after some time, you see the ADX falling. Okay. That means there is deceleration in the strength, or is weakening trend. You see the ADX plummeting below the 20, signifying non-trend conditions. Okay. Sideways kind of action. And you can clearly see that from price action here. Okay. Below coming here. And you see how low the ADX has gone. Trendless conditions. No need to go into this position. Okay. So this may be your signal to exit the position once you see the ADX plummeting below 20. Okay. So you could have gone short somewhere in here at best. Okay. And you close the position once you see the ADX plummeting below the 20, signaling weakness in trend or no trend conditions. Therefore, you could have interpreted this as, you know what, there's no enough trend, there's no prices not going to fall much more or at a faster pace. what's the point of staying in this long position short for the foreseeable future? I'm going to exit the position. I'm going to capitalize. I'm going to realize my profits. I'm going to move onwards. And when these same conditions arise once again, a pickup of the ADX, much like you saw here, I'm going to go short once again or long, depending on the situation. I mean, open the position and close them accordingly, and you can see the signals here. I'm just laying it out for you rather than just going short and saying, oh, you know what, I'm going to stay short forever. Okay, you could do that, but you have at the same time in this kind of period where you saw inaction, you could have flipped to a different chart, different instrument, and capitalize upon a rising ADX kind of value where you could have gone either long or short depending on the situation, rather than just staying in this trendless fashion forever. Okay, at least that's one way to go at it. Okay, and moving onwards, you see trendless conditions taking place. Yes, the bears were in control. The bulls were also in control. There was a crossover, but look at the ADX. ADX is plummeted. No shift. Maybe there is a slight shift in the strength between the bulls and the bears, in the dynamic between the two, but there is no strength of a trend. So no way whatsoever this would have been a signal for going long. Okay, because the ADX is depressed. The ADX is plummeting. Okay, where you would have been in a lovely position to go short once again in this kind of situation is this. Again, in this kind of case, negative earnings is signified in red, may have missed something out of the two, or both the EPS and the revenue targets, as they have expected in the prior kind of announcement. Confirmation comes. You see bears re-entering the picture as they got the confirmation that, you know what, in the past we saw Snowflake underperforming. We got the confirmation from the earnings call. There's one way for this stock to go, which is down. They're not performing good. Short the stock. So in this kind of case, once again, bears enter the picture with strong momentum, okay, strong selling pressure. Bulls are nowhere to be found. Once again, cross below the 20 and plummet to the 8.8. And look at the difference between the two. Look at the negative DI with the positive DI, okay? Negative DI is at 45, positive DI is at 8. I don't know how many magnitudes or multiples higher that is, but there's only one thing in my mind. The bears are in control. The bears' strength is supreme. And you got also the confirmation by the rising of the ADX out of nowhere, okay? Selling pressure was supreme. So go short, for example, when you see the ADX picking up from 20, okay, which is somewhere, let's get somewhere approximately in here, okay? So go short somewhere around 140. And for the time being, you see the negative DI perking upwards, positive DI pointing downwards, ADX is picking up. There's no other trade to take here. It's short and stay short, okay, with this kind of trade. If you see a shift in either the positive or the negative DI, then you adjust accordingly. But for the time being, this is definitely a short position, clear as day short position. And you also got the confirmation from using your charting tools. You see a 4-day high here, okay? You saw higher lows, one here, one here, one here, and one here. Higher highs also, 2, 3. From there onwards, however, you see the peak, fall, new low, this is the new low, okay? Lower high, some slight shift in trend, which was in this area we just saw. Negative ADX, however, signifies trendless market conditions, sideways, obviously. And from here onwards, once again, you see spike in selling pressure. Price action moves to lower ground. Price action, does not break above the descending trend line. Second confirmation that the price action is going to fall to lower ground. I can go on and on and on. If I have had placed an RSI and a MACD, you're going to get a convergence of indications as well. So it would have been 5 maybe 6 out of 5, excuse me, 5 out of 6 indications that this position needs to be taken short. More than enough for me. 5 out of 6 indications coalescing together, short, capitalize upon the downside. Okay. How much time do we have left? Well, not much. So going lastly to this final example. Hopefully we're going to have enough time in the next week's webinar. We're going to do base case scenario. We're going to do all the indications together to see what I mean in practice, what I do in practice. In this kind of scenario, we have a visualization of the ADX flatlining, which is an indication of a trendless market. Yep. You see the ADX line below the 20, somewhere in this region. Look at it. Never crosses the 20 up until here. Okay. But still, there is not enough indication, or there is no indication. There is no enough interest from either the bulls or the bears, irrespective of who is in control. Okay. In this point in time, the sellers were in control compared to the buyers. What has happened to the price action? Nothing. Okay. Slipped a little bit. In the grander scheme of things, comparing this with this move, this volatile move, which is, what is this company? Sagement Biosciences. Never heard of this before. This is trendless market conditions. Okay. And this is the prime example for you to avoid entering the position. Okay. Unless you're gonna go long near the bottom and cover the position or close the position near the top. Okay, you can do that. You can scalp the channel bottoms and tops. That's one way to do it. But if you want to go and trade with the market and trade with the trend, which is the most beneficial way of trading from my point of view, you stay out of this position up until you see clear indication that the bulls are in control and they have strong momentum on their side. The ADX is picking up and the sellers are out of the question in order for you to go long in this kind of scenario. But this kind of scenario, see, yes, there is crossovers between the two, many false signals. You see the bulls taking control, then the bears taking control, the bulls once again, the bears once again. Endless shift of the trend, of the initiative, but no clear trend, no strength in the current move. Okay, and it's signified by the plummeting ADX, which is below the 20. So use the plummeted ADX as a signal for you to stay out of these positions, these trendless conditions. Okay, up until you see a clear break above or below this former channel. Okay, so easily for example, from TradingView or from whatever platform you are actually using, you could have easily placed an alert, okay, on the upper bound of this, what we call channel here. For example, I want to get alert once the price action breaks above the $5 kind of area, and I want to also get alerts when the price action falls below the 3.8, okay, or $3.80 area. So waiting for either this or this, okay, either a break above or below of the price action. Plus, from here onwards, you're going to well, ideally you want to see is rising ADX, and accordingly a larger ADX value, multiples higher than the negative DI, or larger multiples of negative DI compared to the positive DI. Okay, pretty simple to understand. Yes, you guys have any questions? If not, we're gonna close this right now, unfortunately, because I have to go out and write some lovely reports Friday afternoon. If you have questions, please send them through right now, guys. More than happy to answer them. If not, gonna see you next week. We're gonna do a webinar based case scenario. Gonna lay out at least my point of view of what constitutes a good trade or a bad trade, where to stay in and where to stay out of a trade, where to enter, when to exit, taking into consideration all the technical indications, technical analysis tools that we have in place, do charting analysis. It's going to be a little bit like a trading session. Trading session is going to be on the next 2 Fridays after this, where we're going to go live and do this together. But yeah, next week is going to be analyzing and setting up the plan, okay, before placing a trade. Okay, what do I need to see before I go long or short on a position? Okay, how much chance do I have for it to be on my side or not? Okay, am I willing to risk, for example, 5% to get 25%, or am I willing to risk 5% and gain 6? Okay, that is not a viable trade. That is not a lively level for me to enter a position. I'm not going to go with that. This is the scenario that we're going to discuss next week. Okay, but again, enough me blabbering about stuff. If you don't have any questions, I'm going to leave you to it. Thank you for the kind words, Julio. Much appreciated. Hopefully this has been enlightening for you. This has been easy for you to comprehend. For the time being, take care, boys and girls. Okay, have a lovely Friday. Okay, take care. Bye-bye. Ciao, ciao.